Gold just hit $4,700 an ounce. Then it kept going. Central banks are hoarding it like the apocalypse is next Tuesday. Currencies are wobbling, and somewhere a guy in a bunker is telling his gold bars, "I told you so." So what the hell is happening? Why is everyone suddenly treating gold like it's the only thing that matters? And should you be panicking, celebrating, or just confused? Let's find out. February 2026. Gold isn't just expensive, it's reached levels that would have seemed insane just 5 years ago. We're talking over $4,700 per ounce. For context, back in 2020, gold was hovering around $1,890 to $1,900. In 2015, it was barely $1,100. And now, it's skyrocketed past $4,700 and shows no signs of slowing down. That's not a rally. That's a stampede. But here's what makes this different from every other gold boom in history. This time, it's not just investors buying gold. It's not just doomsday preppers stocking their bunkers. It's central banks, the institutions that control national currencies, that back entire economies, that are supposed to be the adults in the room. They're buying gold like it's going out of style. And when central banks start acting like preppers, you know something weird is going on. In 2024 alone, central banks bought over 1,045 tons of gold. That's the highest level of purchases in over 50 years. China bought gold, Russia bought gold, India bought gold, Turkey bought gold, even Poland, Singapore, and the Czech Republic started loading up. And they didn't just buy a little bit for diversification, they bought aggressively, like they know something the rest of us don't. Because here's the thing about central banks, they don't panic buy, they plan decades ahead. They have economists, analysts, entire departments dedicated to making boring, careful decisions, so when they all suddenly decide to load up on gold at the same time, that's not a coincidence. That's a signal. But a signal of what? To answer that, we need to understand what gold actually is and why it's been humanity's ultimate form of money for thousands of years. Gold is weird. It's a rock. A shiny rock, sure, but still a rock. You can't eat it. You can't burn it for energy. It doesn't pay dividends or interest. It just sits there being gold. And yet for over 5,000 years, every civilization that ever existed decided that gold was valuable. The Egyptians buried their pharaohs with it. The Romans minted coins from it. Medieval kings fought wars over it. And today, in 2026, with all our fancy technology and digital currencies and blockchain innovations, people still want gold. Why? Because gold has three properties that make it the ultimate form of money. First, it's scarce. There's only so much gold on Earth, and you can't just print more of it. Unlike paper money, which governments can create out of thin air whenever they feel like it, gold has to be mined, refined, and physically moved. That scarcity gives it value. Second, it's durable. Gold doesn't rust, decay, or degrade. A gold coin buried for 1,000 years comes out of the ground looking exactly the same. Try that with a dollar bill. And third, it's universally accepted. You can take a gold bar to any country in the world, any time in history, and people will recognize it as valuable. That universality is what makes gold special. But gold isn't just a relic of the past. It's also a hedge against uncertainty, against inflation, against currency collapse, against governments doing stupid things with money. When people trust their currency, when economies are stable, when everything seems fine, gold is boring. It just sits there doing nothing while stocks go up and real estate booms. But when trust breaks down, when currencies start losing value, when people look at their government and think, "I don't trust you with my money anymore," that's when gold shines, literally and figuratively. And right now, in February 2026, trust is breaking down everywhere. For the past 80 years, the US dollar has been the world's reserve currency. That means when countries trade with each other, they do it in dollars. When central banks hold foreign reserves, they hold dollars. When oil gets sold, it's priced in dollars. The dollar has been the foundation of the entire global financial system since World War II. But that dominance is starting to crack. It started slowly. In 2023, China and Brazil agreed to trade in their own currencies, bypassing the dollar entirely. Then Saudi Arabia, which had priced oil exclusively in dollars since 1974, started accepting yuan for oil sales to China. Then India and Russia started trading in rupees and rubles. Then the BRICS nations, Brazil, Russia, India, China, and South Africa, started discussing alternatives like local currency trade, BRICS pay expansion, and a new gold backed settlement unit to compete with the dollar. And in 2025, they expanded their membership to include Saudi Arabia, the UAE, Iran, Egypt, and Ethiopia. That's not a small club anymore. That's over 45% of the world's population and a massive chunk of global GDP. Now let's be clear, the dollar isn't dead. It's still the most widely used currency in the world. It's still the reserve currency. But for the first time in decades, there's real competition. And that competition is making countries nervous. Because if the dollar loses its dominance, if it's no longer the default currency for global trade, then what? What happens to all those trillions of dollars sitting in foreign reserves? What happens to the value of the dollar itself? And most importantly, what can countries hold that won't lose value if the dollar wobbles? Gold. That's the answer. Gold doesn't care about geopolitics. It doesn't care which country is in charge or what currency is dominant. Gold is gold. Everywhere. Always. And that's why central banks are buying it. But dollar dominance isn't the only reason gold is surging. There's another, more immediate problem, inflation. And not the kind of mild 2% per year inflation that economists say is healthy. We're talking about the kind of inflation that makes your grocery bill unrecognizable and your rent payment terrifying. In 2021 and 2022, inflation in the US hit levels not seen since the 1980s. Prices for food, gas, housing, everything skyrocketed. The Federal Reserve raised interest rates aggressively to try to bring it down, and by late 2023, inflation had cooled to around 3 to 4%. But here's the problem. It never went back to 2%. And in 2025 and early 2026, it started creeping back up. Why? Because the fundamental causes of inflation never got fixed. Governments are still spending way more than they collect in taxes. Central banks are still printing money to cover deficits. Supply chains are still fragile. And geopolitical tensions keep disrupting trade. So what do people do when their currency is losing value? They look for something that holds value, something that can't be inflated away by central bank printing presses. And historically, that something has always been gold. Think of it this way. In 2020, a loaf of bread cost $2.50. In 2026, that same loaf costs $4. Your dollar just lost 37% of its purchasing power. But if you held gold in 2020, when it was $1,890 to $1,900 an ounce, and you still hold it now at $4,700 an ounce, you've actually gained purchasing power. Gold didn't change. The dollar did. That's why gold is called an inflation hedge. It doesn't go up in value. It stays the same. It's the currency that loses value. And when currencies are losing value globally, people flock to gold. Now let's talk about the elephant in the room. The world is a mess right now. And I don't mean that in a vague, philosophical sense. I mean it in a very specific, multiple wars and economic crises happening simultaneously sense. The Russia-Ukraine war is still ongoing as of February 2026 with no real end in sight. That conflict has disrupted energy supplies, food supplies, and created massive instability in Europe. Then there's the Middle East, which has been a tinderbox for decades but has gotten significantly worse. Tensions between the US and China over Taiwan remain sky high, with both sides conducting military exercises and making threats. And on top of all that, there are smaller conflicts, political upheavals, and economic crises popping up all over the world. When the world is stable, investors put their money in stocks, bonds, real estate, things that generate returns. But when the world is chaotic, when wars are breaking out and governments are collapsing and trade routes are being disrupted, investors want safety. They want assets that will hold value no matter what happens. And there's nothing safer than gold. This is why gold is often called a safe haven asset. When everything else is falling apart, gold holds steady. In fact, gold often goes up during crises because everyone rushes to buy it at the same time. It's the financial equivalent of a bunker. You hope you never need it, but when the bombs start falling, you're really glad it's there. And right now, a lot of bombs are falling. metaphorically and literally. But here's where it gets really interesting. It's not just that central banks are buying gold because they're worried about inflation or geopolitical chaos. They're buying gold because they don't trust each other. Let me explain. For decades, the global financial system operated on trust. Countries held US Treasury bonds as reserves because they trusted the US government to pay them back. Countries kept dollars in their central banks because they trusted the dollar's stability. And if a country needed to borrow money or settle debts, they could use the global banking system because everyone trusted the system. But that trust has been eroding. In 2022, after Russia invaded Ukraine, the US and Europe froze Russia's foreign currency reserves. Hundreds of billions of dollars just frozen, inaccessible. Now, you can argue that Russia deserved it. That's a separate debate. But from the perspective of other central banks around the world, that move set a terrifying precedent. It meant that holding dollars or euros in a foreign bank wasn't actually safe. It meant that if your country did something the US or Europe didn't like, your reserves could be frozen too. So what did central banks do? They started moving their reserves into something that can't be frozen. Something physical that they can hold in their own vaults. Gold. China reportedly holds over 2,300 tons of gold as of 2026, and many analysts believe the real number is much higher because China doesn't fully disclose its reserves. Russia has been steadily increasing its gold holdings for years. Turkey nearly doubled its gold reserves between 2023 and 2025, and even smaller countries are getting in on the action. This is a fundamental shift. For decades, trust in the dollar and in the global financial system held everything together, but now that trust is fracturing. And when trust breaks down, people go back to the oldest form of money humanity has ever known: gold. Now let's zoom out and look at the bigger picture, because gold's surge isn't happening in a vacuum. It's happening at the same time that a lot of other assets are starting to look shaky. For over a decade, from roughly 2010 to 2022, we lived in an era of cheap money. Interest rates were near zero. Central banks were printing money like it was going out of style. And all that cheap money flooded into assets. Stocks went up, real estate went up, cryptocurrencies exploded, even art and collectibles became investment vehicles. Everything was going up because there was so much money sloshing around the system looking for returns. But that era is over. Interest rates are higher, central banks have stopped printing money, at least temporarily, and a lot of those inflated assets are starting to come back down to earth. The stock market has been volatile. Real estate prices in many cities have started to fall. Cryptocurrencies have crashed multiple times, and investors are realizing that a lot of the valuations from the 2010s and early 2020s were based on cheap money, not actual value. So where does money go when everything else looks overvalued and risky? Gold. Because gold doesn't have earnings reports. It doesn't have a CEO who can screw things up. It doesn't depend on interest rates or economic growth. It just exists. And in an environment where nothing else seems safe, that simplicity is attractive. So now the question everyone's asking: should you buy gold? Is this the start of a historic bull run, or is gold about to crash back down? Here's the honest answer: nobody knows. Anyone who tells you they know for sure what gold is going to do is lying or trying to sell you something. But we can look at the factors driving gold right now and make an educated guess. The bull case for gold is strong. Central banks are buying aggressively and show no signs of stopping. Geopolitical tensions are high and likely to stay that way. Inflation's proving stubborn and could flare up again. Trust in fiat currencies, especially the dollar, is declining. And if any major crisis hits, whether it's a financial crisis, a war, or a currency collapse, gold will likely surge even higher. In that scenario, $4,700 per ounce could look cheap in hindsight. But there's also a bear case. Gold doesn't generate income. If you buy gold and hold it, it just sits there. You don't get dividends or interest. So if inflation calms down, if geopolitical tensions ease, if trust in the dollar stabilizes, gold could stagnate or even fall. And if central banks suddenly decide they have enough gold and stop buying, that could remove a major source of demand and cause prices to drop. So what should you do? If you're thinking about buying gold, here's what you need to know. Gold is not a get rich quick scheme, it's insurance. It's a hedge against worst case scenarios. If you think the global financial system is stable and everything is fine, you probably don't need gold. But if you think there's a real risk of inflation spiraling out of control, or currencies collapsing, or the global order breaking down, then having some gold makes sense. Financial advisors generally recommend holding 5 to 10% of your portfolio in gold or other precious metals. Not 50%, not 100%, just enough that if everything else goes wrong, you have something that will hold value. Think of it like home insurance. You hope you never need it, but you're glad it's there if your house burns down. And if you do buy gold, buy physical gold. Coins, bars, something you can actually hold. Not paper gold, not gold ETFs that claim to be backed by gold but might not actually have it. Physical gold that you control. Because if a real crisis hits, you want the actual metal, not a promise that someone else is holding it for you. So what happens next? Where does gold go from here? Again, nobody knows for sure, but there are a few scenarios worth considering. Scenario 1, gold keeps climbing. If central banks keep buying, if geopolitical tensions keep escalating, if inflation stays high or gets worse, gold could hit $5,000, $6,500, or even higher. In this scenario, gold becomes the ultimate safe haven, and everyone who didn't buy it kicks themselves for missing out. Scenario 2, gold plateaus. Maybe $4,700 is the new normal. Central banks slow down their purchases, the global situation stabilizes somewhat, and gold just sits at these elevated levels without moving much. Not a disaster, not a windfall, just expensive gold. Scenario 3, gold crashes. This is the bear case. Maybe the world doesn't fall apart. Maybe inflation comes down, trust in the dollar rebounds, and all the fear driving gold evaporates. In that scenario, gold could fall back to $2,000 or even lower, and everyone who bought at $4,700 loses money. Which scenario is most likely? Honestly, scenario 1 or 2 seem more probable than scenario 3, at least in the near term. The structural factors driving gold, central bank buying, currency instability, geopolitical chaos, aren't going away anytime soon. Even if gold doesn't keep climbing, it's unlikely to collapse unless something fundamental changes. But here's the thing, gold's price isn't really the point. Gold's surge is a symptom, not the disease. The real story here isn't that gold hit $4,700. The real story is what that tells us about the world. It tells us that central banks don't trust the current system. It tells us that currencies are losing credibility. It tells us that the financial order that's been in place since World War II is breaking down. And it tells us that we're entering a period of uncertainty, instability, and risk. Gold is just the messenger, and the message is things are not okay. So let's bring it back to the original question. What the hell is happening to gold? Gold is surging because the world is changing. The dollar's dominance is being challenged. Inflation is eating away at currencies. Geopolitical chaos is making everyone nervous. And central banks, the institutions that are supposed to be calm and rational, are buying gold like they're preparing for something bad. Is that something bad going to happen? Maybe. Maybe not. But the fact that central banks are acting this way should tell you something. They have access to information and analysis that most of us don't. They have entire teams of economists modeling every possible scenario. And they've decided that gold is worth accumulating. That's not random. That's a signal. For you, the individual, the lesson is simple. Pay attention. Don't ignore what's happening just because it doesn't affect your daily life right now. Understand that the financial system we've all grown up with, the one that seems stable and permanent, is not as solid as it looks. And consider whether having some gold, even a small amount, makes sense as insurance against an uncertain future. Because if history has taught us anything, it's that when empires fall, when currencies collapse, when financial systems break down, gold endures. It always has. And if the current trajectory continues, it always will. So the next time someone asks you what's happening to gold, the answer is simple. Gold is doing what it's always done. It's being gold. It's the world around it that's changing, and that should probably worry you more than the price of gold ever could.